Let's build a better world for investing.
Let's lead in improving the quality and standards of the financial profession.
Keep you abreast of financial innovations here and abroad.
Be known for our integrity and professional excellence.
Let's always put investors' needs above our own.
Push for financial literacy.
Provide service to the investors through the selection of the best managed funds of the year.
Let's build trust in our industry.
Advocate on behalf of industry issues.
Convince trust and asset management companies to adopt the Asset Managers Code and the Global Investment Performance Standards.
Let's put ethics at the heart of everything we do.
Talk about ethical decision-making.
Encourage ethical behavior and be really passionate about it.
Let's create an environment where investors' interests can flourish.
Markets function at their best and economies grow.
For the ultimate benefit of the Philippine society.
I am Chris Arceo.
Mark Yu.
Erwin Ocampo Avante.
Rob Ramos.
Sandra Aralia Gonzalez.
Mark Ilaw.
Kate Burgos, and I am CFA Charter.
We
measure up. Join us.
Let's measure up.
CFA Institute is a global association of investment professionals that sets the standard for excellence in the industry. Since its foundation in 1947, CFA Institute has aggregated about 100,000 members and candidates in the fastest growing region, Asia Pacific. In response to extensive demands, CFA Institute has created the Asia Pacific Research Exchange, or ARX, an online research platform focused on investment management. Covering 18 major markets in the region, ARX provides content on over 20 investment subjects, including within the fields of knowledge application, academics and regulation. Leveraging the extensive membership network and industry resources of CFA Institute, ARX is a sharing platform, feeding its users a great deal of first-hand industry news. ARX is also a learning platform, as a large number of high-quality research papers enable its users to stay abreast of all popular investment topics in the region. Beyond all that, ARX users can hear each other and find industry peers by publishing articles and research reports, making it a highly interactive platform. For more details, please visit www.arx.cfa. ARX is your preferred financial research platform for sharing, learning and interacting.
Good afternoon, everyone. Welcome to the Investor Series Talks webinar. Thank you for being here today with us. My name is Monzen Malyari, Data Management Subgroup Manager of Citibank, and I am your host for today's online event. Before we proceed, we would like to take this opportunity to recognize our annual corporate sponsors. Platinum sponsor, Sea Oil Philippines Incorporated. Silver sponsors, BDO Capital, Coco Life Asset Management Company Incorporated, and FTI Consulting Philippines Incorporated. And bronze sponsor, AP Securities Incorporated, DBP Daiwa Capital Markets Philippines Incorporated, and Papa Securities Corporation. Event partners are FMAP, Mart, and Sharefill. To formally welcome us all, may we please have the President and Chairman of CFA Society Philippines Incorporated, Dr. Robert Ramos, CFA, CAIA, CIPM.
Thank you, Monzen. It's a pleasure to be here. I hope that everybody is well and keeping safe. I've always believed that during the most trying times, every individual can find ways to improve. Obviously, my favorite example is obtaining the CFA charter is one path to self-improvement, while learning from others is another. In this talk, I do hope that you pick up a lot of pointers on how you can traverse the road to further knowledge and self-improvement and knowledge in scaling the corporate ladder. Thank you to our speakers for sharing their knowledge, and thank you all for attending this webinar. Back to you, Monzen.
Thank you, Dr. Ramos, for the warm welcome. Again, welcome to the webinar. This webinar is brought to you by CFA Society Philippines. Before I introduce the speaker, may I remind the audience to please feel free to ask your questions in the chat box, as we will have a Q&A session later, and we will definitely welcome any and all questions that you may have about stocks or about whatever is in your mind. So joining us today to talk about stocks is Charles William Ang. Charles is currently the head of research at COL Financial, a position that he has earned through more than a decade of analyzing companies since joining the firm in 2010. He also serves as director for curriculum development and senior faculty instructor at the Kalum Trading Institute, a premier educational facility in the Philippines that aims to develop successful traders of global markets. As an advocate of financial literacy, he regularly conducts stock market and financial analysis seminars for COL Financial, Kalum, and CFA Society Philippines. Charles graduated cum laude from the Ateneo de Manila University with a Bachelor of Science in Management Engineering in 2009. He became a CFA charter holder in 2013. So without further ado, may we call on Charles William Ang, CFA.
Hi, good afternoon. Thank you, Monzen, and thank you to the Society for inviting me here. Okay, so when I was first approached to give this talk, at first I wasn't quite sure on what exactly to talk about, because I'm thinking that, you know, compared to the other topics that we've had for this investor series, I would say that you're probably most familiar with the stock market, right? You've probably had exposure either directly, you know, investing or indirectly through your friends or to your family, right? So I wanted to structure the presentation slightly differently, to be able to hopefully be you know, beneficial to all of you guys. As Monsen mentioned, I do encourage any questions that you may have. I'm aiming to finish my slides in about 30 minutes, so we have lots of time for questions if needed, right? And yeah, so without further ado, my title for today's presentation is the 4 common misconceptions about the stock market. All right, so let me just play my slide. Hopefully everybody can see it. All right, so 4 common misconceptions about the stock market. So again, I'm sure a lot of you are already have some insights or some idea on what the stock market is, right? And the number one misconception that I want to talk about is that investing is hard. Okay, some of you probably were not into the stock market. Maybe have friends, maybe overhear them talking about the stock market. They talk about a lot of different things, right? They talk about, they talk about earnings, they talk about revenues, they talk about competition, they talk about the global factors, global recession, the Ukraine war, everything, so on, the Fed tightening, so on and so forth. So there's lots of, it seems like there's lots of variables that you need to know and lots of things that you need to understand to be able to invest. But I'd like to push back on that a little bit and say basically that it doesn't have to be difficult. Okay? It may be difficult, but it doesn't have to be. And at least at the very start, okay, it's not difficult. I really believe that each one of you, everybody here, will be able to invest profitably on your own, right? And yeah, so lots of different questions that you might be asking prior to starting, right? How do I start? What do I buy? When do I buy? When do I sell, right? Where do I get all these information, right? So it seems so complicated, right? So let me first try to simplify things for you as a starting point. So para medyo, for those of you who are not yet into the stock market, maybe would motivate you a little bit, right? So I share these rules to even my friends who ask me to ask me for advice on how they can get started in investing or in the stock market. And these are the 3 simple rules that I've been saying all this time. No? Number 1, right? Set aside 10 to 20% of monthly income. Okay, the assumption here is that you have your full-time job. I mean, some of you are probably your students, but eventually, hopefully, you'll get a job, right? That would give you that consistent cash flow, right? So set aside 10 to 20% regularly, right? And number 2, just buy good quality companies, right? Number 3, invest regularly, right? So not just a one-time thing, but invest. Usually, we recommend like monthly investing, right? So you could even set the date, like the first Monday of every month or whatever, right? So invest regularly, do peso cost averaging, and invest over the long term. So just 3 very simple rules, right? I could even make it a little bit more simpler, right? If you don't know, we might say, okay, what about number 2? How do I know which companies are good, which companies aren't good? Okay, fair enough, right? If that is an issue, then I do recommend equity index funds. Basically, these are, how do you say it? Funds that track the performance of the biggest companies in the Philippines, the 30 biggest companies in the Philippines. So if you don't want to choose, right? I mean, you don't have confidence yet in your stock selection, then just invest in the average, right? So you would perform in line with the average. No? Yeah, at this point, I'm not expecting any of you guys to be convinced na parang, okay, it's simple, ito lang pala kailangan gawin. I don't really expect that. But hopefully, for the rest of my presentation, I'm able to explain why these rules, however simple it is, would set you up well to make it in the stock market. All right. So let's go through them. Right. And okay, so I usually start with this. So the reason why it works, the reason why this works is that investing is essentially about owning a business, right? When you buy a share in Jollibee, you're effectively becoming an owner of the Jollibee franchise, right? Of course, if you buy, let's say, 10,000 pesos worth, that's probably just about 0.0001% of Jollibee, but technically you become an owner of Jollibee. And so, and we know that in any business intuitively, right, that the value of that company or the value of that stock will ultimately be tied up to the earnings of that company, right? Simply said, as long as that company is making money, generating earnings, hopefully larger earnings as time passed by, then most likely over the long term, the value of that company would also follow, right? Would also go up, right? And so I'm sure all of these guys are, you know, are very familiar with most of you guys, and of course there's always risk in the stock market. We're not sure. Maybe a case in point would be the COVID, you know, pandemic, wherein most of these companies were affected for some time. And I do want to say that at the same time, also in the stock market, there are risks, right? I mean, nothing's guaranteed, but it's as good as saying, you know, I mean, I think it's fair, right, to trust these corporations to continue to generate quality earnings going forward, right? So it's all about owning these businesses. And to give you some more proof, okay, that investing over the long term works, I have a couple of slides here. First one, I got this one from the book Stocks in the Long Run, right? And this shows the performance or the total return of the major asset class, stocks, bonds, bills, gold, and the dollar over the last 200 plus years. 200 plus years worth of data, right? So definitely not a small sample size. And as you can see, over the long term, the stocks, stocks outperform any of the other assets, any of the rest of the asset class, right? And don't get fooled by the magnitude of the outperformance, because the scale here is logarithmic or exponential, right? So you can see, right, stocks at the end of 200 years, $1 would give you $755,000. And the next best thing, which is bonds, would give you $1,000. No, so that's 755 times better, right? So this is an exponential chart. Right. Another, you might say, oh, yeah, this one is in the US. Sorry, the performance of the US market. And you might say maybe it's only true for the US market. And so here in this slide, I have the performance of across countries over the last 100 plus years, right? So different countries like Belgium, Italy, Germany, France, and so on, right? And as you can see, equities, right? The first bar, the black bar here, has consistently outperformed bonds and bills. Right? So similar to what we saw here in the US market, we could say the same thing across most of these countries, right? And yeah, so it's that simple, right? Again, make sure you invest in good quality companies over the long term, right? These guys would generally outperform any other asset class. And again, the underlying reason for that is that when we're buying companies, when we're buying stocks, right, we ultimately participate in the earnings that they generate, right? Yeah, and of course, I guess from a risk perspective, there's no better horse than to invest in the biggest companies in the Philippines, right? Which are the listed companies, right? So what are things that make it harder than it should be? To be fair, the investing is hard misconception, to be fair, has some merits, right? It's not all roses, right? And these are some of the common things, right? Number one, no risk management, right? Number two, lack of patience, wants to get rich overnight. And then number three, lack of discipline and effort. I'll be talking about the risk management later on, but I'd like to focus first on number two. As you can, the historical average, if you compute this one, the historical average for the returns of the stock market over the very, very long term, you could say is about roughly 10%. So plus minus, depending on which country, depending on which time horizon, right? But it's roughly 10%, you can leave it that way. The thing is, for some people, 10% might be a good number, right? And later on, I'll explain further why. But for some, they don't want 10% a year. Yeah. Basically, they want 100% in a week or 100% overnight. They want to get rich overnight, right? And sometimes when we do that, most of the time when we do that, we take unnecessary risks, right? We complicate things. We take unnecessary risk to be able to get that extra return. And that is the dangerous part, Again, more on that later on, right? Number 3, lack of discipline. I've heard this comparison once and I found it very, very, very apt, right? They said that, investing, right, is like exercising, right? Wherein, if you exercise, right, you don't expect that after I exercise for one day, I'll be fit the next day, right? Or I'll be 10 times stronger the next day, right? The same is true for investing, Just because you started it doesn't mean you're going to get rich next week or next month. You have to continuously do that investing, for over a long period of time for it to materialize, for the impact to really be very tangible, right? Yeah. Now, you might say, okay, so first misconception, investing is hard. Investing is hard. Yeah. So I'm arguing, it doesn't have to be hard. But on the other extreme, there are also some people, usually these are the people who have started to already invest in the market. They have a little experience, maybe 6 months, a year. And they might say, hey, hindi nga pala mahirap. Investing is easy. Madali lang pala lahat. Yeah? So this is a second misconception. So unfortunately, I'm also not saying that investing is easy, right? So it's not hard, but it's also not easy, right? And there are several reasons why, but the most important thing, okay, the most important thing that could go wrong is because of volatility, right? And I'll be discussing that later on. We can go to it now and then before we go to the others, right? So volatility, okay. What does volatility mean, right? As I said a while ago, right? When you're investing, you could mostly say that the value of your investment will ultimately be driven by the growth in earnings. So if you can imagine it as a chart, it would look something like on the left-hand side here, wherein if you see, if you expect earnings to go up, then prices would eventually follow. But in reality, right, you seldom see this relationship being this clean, right? Instead, you'll see something more on the right side of the slide, right? Wherein you see wide fluctuations in the share price. Ultimately, it still goes back to what the fair value is over a long period of time. But this time period could be quite long, and the swings could also be quite big, right? And why does this happen? And the maybe the simplest way that I could explain it is that in the stock market, right, we care about things in the future. Meaning we care about earnings that you're gonna make tomorrow, next year, 2 years from now, and so on, right? And as you know, right, whenever we're dealing with things in the future, there's lots of uncertainty, right? There's lots. If you again going back to the COVID-19 pandemic, which is a very good textbook example of uncertainty when it initially surfaced, and when we first locked down the country, right? Obviously there were lots of uncertainty, right? We don't know whether some of these companies would be surviving. How long will we be inside our homes, right? And so dealing with things in the future, that leads to uncertainty, and the uncertainty leads to volatility, right? And the problem with this volatility is that you might get scared. Yeah, that's one of the the most direct way, right? You might get scared and sell at the worst time. Or volatility works both ways. You might get too excited at the top, right? And buy at expensive prices, right? And so volatility makes investing, right, or trading difficult, right? And so an extension of this is what we call the emotional cycle of investing. For those of you who've already been investing, whether not only just in the stock market but any other, any asset, basically, you might share this, this experience, right? So let's go to the cycle, briefly, right? So yeah, so this is emotional cycle of investing. If we start with the left side first, yeah, let me see if I could. Can I do? Never mind. It's okay. All right. So yeah, we start with the left side first. Usually, we can start with a no interest state, wherein nothing's really happening in the share price. It's not moving up significantly. It's not going down. There's not much volume, and then eventually there's a rumor that comes in the market, right? Whatever it is, whether it be company specific, or let's say, the rumor is, Fed would already start to, reduce interest rates, to pivot. And so any rumor, and then you see a little bit of, price action in the stock or in the index, right? But it's not sustained because we're just in the rumor stage, right? Nothing's really sustained because we're not sure. There's a chance that it could happen. There's a chance that China could remove their zero COVID policy. These are just rumors, no? But eventually, as things materialize and as more signs surface, then we start to gain more confidence, and then you see a more sustained price action in the share price, right? More sustained uptrend, and I'm sorry about that. Right? So more sustained price action, right? And then ultimately, as that's the human nature. The more you see price action confirming your view, the tendency is for you to be more optimistic. Parang tama na ata ako kasi araw-araw umaakit yung share price. Parang kumikita na ako. I think this is it. I think it's true, right? Whatever the rumor is, right? And so you get to the optimism stage. And then what happens here in the optimism stage? Usually, kumikita ka na dyan, eh. So what do you usually do? Usually, you probably gonna buy more, right? You're gonna add to your position kasi optimistic na ako eh. Dati, hindi pa ako sure. Now I'm optimistic, right? So I probably add more shares, right? Deposit more to my, to my account and prepare to buy more. Yeah, and then you start to, encourage your friends to invest as well. And if a lot of people do this, then you see another surge in the price action, diba? An even stronger surge, right? And then we go into what we call the instant wealth stage, wherein basically whatever we're buying, it's going up, diba? If we buy today, 2, 3, 4 days from now, we're up, we're super happy, we're super confident. I mean, we feel like we could retire. We could do this full time. We don't have to work anymore, so on and so forth. So usually what happens there? So that's the instant wealth stage. What happens then? Again, you probably, if you know leverage, you probably use that already. Borrow money to invest more. You probably invest. Tell anybody who's willing to listen, hey guys, you should be investing in this asset already. It's a no-brainer. You're gonna get left behind. There's no other choice. It's going to the moon, whatever, so on and so forth, right? And so, yeah, so yeah, if everybody does that, if everybody continues to buy aggressively, then we enter the last stage, which is the irrational exuberant stage, wherein prices really skyrocket, right? And at the peak, this is usually where you hear everybody in the street saying that, talking about these assets, right? And the thing is, right, at the peak of the market, at this point in time, diba? If you think about it, everybody who could be investing are already investing, right? Everybody that you could convince have already been convinced. Diba? Kumbaga lahat ng pera nakapasok na. So the problem with that is no more new money, right, would be able to come in. And so the next consolidation stage, you think probably, oh yeah, this is normal pullback, no chance to add more, to buy more. But the moment that it doesn't go to new highs anymore, then we go to the next stage, the selling panic now. Parang, teka, iba na to it didn't go to new high anymore, right? Now I'm starting to see losses, right? And so you go to the selling panic, and then after a while, right, you go to lost wealth, right? The funny thing is, even if we're just halfway in the chart, I'm not sure if you could see my mouse, but even if we're just halfway in the decline, right, most of the people are already losing money during this time, right? In the lost wealth, this number 9 here. And that's because usually we are more heavily invested at the top than at the bottom for behavioral, for psychological reasons, right? And so even if the pullback is just 50% of the move, most of us are already wiped out, right? And what comes next, right? If you're wiped out, ayoko na mag-invest. This is not for me. Never again. I'll just sell anything. I don't care whatever the price is. I just don't want to see it anymore. Sell everything and I'll leave the industry na. So we go to the lost wealth stage, or the desperation and the capitulation stage, right? And then, of course, at the pag sumuka na lahat, then you have your short-lived confidence kasi wala na. Everybody who sold has already sold, right? And then so you have short-lived confidence, and then you go back to the no interest stage. So we complete the cycle again, go back to the no interest stage. Right? So this is the usual cycle. So I hope that for some of you who've already been, has experience, in any markets, then maybe nakarelate kayo ng konti. That's very good, for educational purposes. But and the thing is, this happens over and over and over and over again, right? These are just some examples. And by the way, this one isn't drawing. This is an actual chart of the Shanghai Stock Exchange Index. During the 08-09 global financial crisis, right? It's an actual chart, right? And yeah, so again, some other examples would be the tech bubble. On the top left side, notice how it looks exactly, very, very similar to the previous chart, right? And then on the right side here, these are more recent examples. You could, on the top right would be Zoom, right? The one we're using today. Just imagine the volatility, in share price. It peaked during 2020, end of 2020 at $575. Now it's doing at $80, right? Yeah, so basically the roller coaster of emotions, nandito lahat, diba? On the bottom right, we have ARK Investments, which for those of you might know, they invest in a basket of tech companies, innovative tech companies with very high growth. And so you could see, during the pandemic, a lot of investors got super excited with all the the innovation, quote unquote, right? And so you see share price rally. But now, once everything's back to more or less more normal times, again the share price also plummeted. Right? Even in other assets. So this is not only true for stocks. Even on this one, bottom left, we have the chart of Ethereum. I think you've briefly discussed that last month. With the crypto topic, right? So even the Ethereum chart looks exact. It looks very similar, right? So and the reason why this is so is because of human emotions. This is caused by our own human frailties, right? And so we don't expect these cycles to stop, right? It's gonna happen over and over and over again. And the problem with this one, we're trying to explain things that could go wrong. The problem with this one is that these cycles could take a very long time to unwind, right? And because of the the duration of time, sometimes it doesn't. I mean, like investing sometimes doesn't make sense anymore. Like, let me give you an example. This is a chart of Microsoft. Yeah, the maker of the Windows, right? From I think 1996 to 2011. And as you can see, after the Asian financial, not Asian, the tech bubble in 2000, after the peak, right? You see basically the share price of Microsoft just stayed flat for 8 years, from 2003 to 2011, sideways for 8 years. During that time, okay, earnings of Microsoft tripled. Tripled. Right? So you might say, sabi mo lang kanina, di ba? Ultimately tied to earnings. But because of this emotional cycle of investing, the overshoot in terms of valuations during the tech bubble was more, and the subsequent crash, the subsequent impact of the large decline in share price basically caused the share price to be depressed for a long period of time, despite improving earnings, right? So that's the challenge, no? Okay, so how do I reconcile? So far at the start, I've said that investing is not hard because over the long term, stocks outperform, right? How do I reconcile that with saying that, for 8 years, sometimes stocks don't go up, right? And the answer is on this slide. Okay, so here we have, hopefully try to follow it with me. It's a little bit a little bit busy, right? But here we have the performance of stocks, bonds, and bills. So the first bar is the stocks, second bar is the bonds, third is the bills, and their maximum and minimum return. I think this is over the last 200 years, right? The last 200, also from 1800 to 2006. So the last 200 years. So the way I would read it, if you look at the holding period, the 1 year holding period towards the leftmost, meaning the last 200 years, the worst year for equities is a down 39%. That's the worst 1 year performance. The worst 1 year performance for bonds is negative 21.9%. On the other hand, the best year for stocks is 66%. The best year for bonds and bills, 35%, 23% respectively. Hopefully you guys can follow, right? And if you just focus on the shorter term periods first, right? The 1 year, the 2 year period first, it makes sense what I'm saying just now, that stocks are really more volatile than bonds and bills. Yes, they do offer higher maximum return at 66%, right? But they also offer bigger downside, right? And you might say, yeah, yun nga, that's the thing with stocks. Kaya ayaw ko mag-stocks kasi high risk, high reward. That's fair. That's fair. But I would like you to focus now on the longer end, on the right hand side of the chart, of the exhibit, right? As we move along from 1 year holding period to 2 years to 5 years, and maybe we could look at the 10-year holding period, right? At the 10-year holding period, we're already here. The worst 10-year average return, okay? The worst 10-year average return for the stock market is negative 4%. Why is this important? Right? Because at this point in time, over the last 200 years, the average is now, the average drawdown, the maximum drawdown is 4.1%, and that is now smaller than the maximum drawdown for bonds and bills over the same period of time, right? So it's now less risky in a way, right? Because again, the way we interpret this, if you get any 10-year period, even if you want to get let's say the World War, World War I, World War II, 1930s to 1940s, any 10-year period that you can think of, the worst return is a negative 4.1% per year. That's not good, but as a worst case, that's better than bonds and bills. And if we move further along to the 20 years and the 30-year period, something even more important happens, right? And that is that the minimum return, okay, the lowest return over a 20-year period or a 30-year period is a positive number. Meaning, in other words, okay, there hasn't been any 20-year period in the history of the US market, the past 200 years, wherein stocks didn't make money. Okay, at this point, I'd like to put out a caveat, okay? Am I saying that it's not going to happen? It's impossible to happen going forward? Of course not. Nothing is impossible. And we always say past results not guarantee of future performance, right? But I'm just saying, I think it's safe to say that the odds are with you. That if you get any 20-year period in the future, you're probably going to make money, right? So yun lang. The key is to investing for the long term. That's the key difference. The short-term volatility would be offset by long-term outperformance. And even if we go back to the Microsoft example that I showed you a while ago, I included here. So this is from 1996 to today, right? And so this one, the 8-year period where it didn't go up, it's actually, while it's a long time, in the grand scheme of things, you could say that it was worth it. Because eventually the share price did catch up with the earnings, and your investments basically, grew by tenfold, right? So the key is investing over the long term. So how do we propose that you take advantage? No, but you might say that, okay, but I mean 8 years is just too long, or the volatility is just too much for me to handle, no? And our advice for that, okay, is to do what we call a peso cost averaging or a dollar cost averaging, wherein you buy a company, right, on a regular period, usually monthly. So an equal amount, let's say 5,000 pesos, right, per month on the same day every month, or let's say first Monday, second Tuesday, whatever you want, right? Do it regularly, regardless of where the share price is, right? If it's at the top, if it turns out that it's at the top and the next month the share price declined, then in a way it's good because you'll be able to buy more shares at a lower price. If it goes up, at least may nabili ka na last month. No? So you'll never the chance, no, of, let's say malas ka, you invested at the very peak of the tech bubble, and you won't basically you're just gonna break even after 10 years. That risk would be minimized if you spread your purchases over several months, right? So that's why this one works. Peso cost averaging works. Okay, some people might say, hey, what if nag-peso cost averaging up, but it went down over time? That's true. You're not gonna make money. This is not just a magic thing that would make any asset profitable, right? It's just a timing tool. It just removes your need to time your purchases. Diba? That's one of the biggest issues when we're investing, right? We don't know when to buy. Ngayon ba tayo bibili? Paano pag bumaba bukas? Diba? Bukas ba tayo bibili? Paano pag umakyat? Diba? So by doing the peso cost averaging, it removes the burden for us to time our purchases. Anyway, we're gonna buy next month again. So kahit mababa ngayon, mataas ngayon, who cares? I'm gonna be buying next month anyway. Right? So, yeah, but again, as a caveat, this would only work if you're buying good quality companies. Okay? If you're buying a company that's worth nothing, even if you peso cost average, right? Prices are just going to continue to go down, and it's still going to be worth nothing. Okay? It would only work for good quality companies with earnings that growing over the long term. Okay. Again, if you're not sure, if you don't know how to to judge good quality companies, then just buy the index, right? Buy the average. All right. And so in the same light, no, but at the opposite extreme, this is why leverage is very, very dangerous. Now, for those of you who don't know, leverage is, or margin trading or margin investing is when you use other people's money, when you borrow money to be able to increase your purchasing power, to be able to buy more. That is the reason why it's very dangerous, is because, right, it could force you to sell at the most inappropriate time. Diba? Because it's not yours. Leverage, basically, that money isn't yours. So sometimes when share prices decline, diba? Pag nag-EIP, when it declines, it's good, you could buy more. But if you're leveraged, when it declines, the lender of that money might force you to sell because he doesn't want to risk his money. Right? And so, yeah, so for those of you who basically have limited experience or no experience in the stock market, I highly advise against using leverage, right? If you really want to do it, make sure you understand it 100%, all the consequence, all the scenarios that we have in leverage. All right? Okay, so you might say at this point, okay, sir, you just said I can't use leverage, okay? But the problem is I only have X amount in capital. I only have 20,000. I only have whatever amount that you have, 20,000 in capital. Is it still worthwhile to be doing all this? Diba? Ang hirap, ang dami pa rin isipin. And then what? Even if I make 10% of 20,000, that's only 2,000 a year. What am I gonna do with 2,000 a year? Right? It's just a small amount. Is it still worthwhile? And for me to answer that, we have to look at, as they said that, Albert Einstein allegedly called this the eighth wonder of the world, the power of compounding, right? This basically deals with the human's inability to understand, to intuitively understand compounding. Exponential growth, diba? Nangyari ito again during COVID, diba? People, initially, 50 cases, 10 cases, 20 cases. Eventually, it went to 10,000, 20,000, 30,000. And people were panicking because what they're experiencing is an exponential growth, not a linear growth, right? And so it could accelerate quickly. Diba? That's the thing with compounding. And again, this is just to show you, right? If you invested 50,000, just a one-time investment of 50,000 at 8% annual return, 8% happens to be the long-term average of the Philippine market. Diba? I mentioned a while ago, globally it's about 10%, but depending on where you are, what time period, it could fluctuate a bit. For the Philippines, the long-term average is 8%. So let's say we use that. After 30 years, that would be 10 times your money. You might say at 10 times 503,000, still not small, still not big, right? But that's only a one-time investment. No. That's the reason why we said a while ago, diba, to invest, to set aside 10 to 20% monthly, right? Hopefully every month, right? You put in the money, and then over time it's gonna accumulate faster than you think. Right? The best example I could give here is Buffett's net worth, right? Which is an example of an exponential curve as well. So you could see early years, parang normal na tao lang, and then eventually, diba, one of the richest people in the world, right? So I often say, right, don't invest now because you want to get rich tomorrow. As in tomorrow, as in 24 hours from now. Don't do that. Instead, trust the process. We're investing over the long term, right? Again, it's just like exercise. Just every day you have small gains, small gains, small gains. One day those gains would compound, and there will be a day wherein the earnings that you generate from your stock investments would overtake the earnings from your salary, right? And there will even be another day, not too further along, right, wherein that stock investment would now make your future retirement very comfortable. But you don't have to rely on anybody else or anything else anymore, right? So that's the power of compounding. And the good thing with investing in the market is you could literally invest until you're as old as Warren Buffett or even older, right? There's no cap. As long as you're alive, you could be investing because you're literally just reading and clicking your mouse, right? And another thing that compounds over time, okay, is learning. right? Um, you know, I often compare the stock market to anything else that you can learn, any skill that you want to learn. Let's say you want to play the piano, you wanna learn how to to play whatever, soccer, I don't know, um, basketball. You want to learn how to compose music, whatever skill that you want to do. Certainly you don't expect to master that skill on day one, right? Or even on day 30, right? But over time, right, if you continue working on it, right, then the skills would build up more and more, right? So don't expect to know everything on day one, but don't underestimate what you're capable of on day 365 or on year 10, right? And so yung advice ko lang dito, I often tell people, because they're usually they're scared of the number of, they're uh they're afraid of the number of things that they need to know. But I just always tell them, okay, just read 15 minutes a day. I'm sure you have extra 15 minutes a day, whether you're using that in Facebook, TikTok, whatever you're using right now. I'm sure you're spending hours there. Just 15 minutes a day. Just set aside 15 minutes. I don't care what you read. Just read anything about the stock market or whatever skill you want to learn. 15 minutes a day. You'll be surprised after 365 days how much of it you understand. After on year 10, how much of it you understand. And okay, just to bridge everything again, because I said a while ago, investing doesn't have to be hard. Yes, that's true. It doesn't have to be hard. You can make 8% a year compounded. But if you do this, if you invest on the learning also, not just on the capital, but also on the learning, then maybe instead of 8% compounding, you're doing 10% compounding, you're doing 12% compounding. And you could do this as an exercise by yourself, diba? The difference between an 8% compounding over 30 years and a 12% compounding over 30 years is basically night and day. It's not just a 4% increase. No, because of the power of compounding, the impact is also quite big. So you can do that on your own. You can compute that on your own, right? Right. And last one before a little bit longer than I expected, but last couple of slides before we go to Q&A. Okay, last misconception is that there's only one game in town. Diba? What do I mean by this? Because as I said, I'm sure even if you don't have a direct exposure to the stock market, maybe you have some friends, you know somebody, right? You've heard of somebody who's into the stock market, and for some reason you might say that, hey, I don't really like what it's doing, then maybe the stock market is not for me. Diba? You might have some friends who who one day were just gamblers. One day they're up 50%, the next day they're down 50%, right? And you might say, that's too risky for me. I don't want to do stock market. Maybe you probably overhear people manipulating the market, right? Or benefiting or capitalizing on market manipulations, right? And you might say, I don't want to do that. I'm ethical. I don't want to do that. And so on and so forth. So what I want to say is that the stock market, there's a place for everybody in the stock market. You don't have to gamble to be in the stock market. You don't have to be a manipulator to be in the stock market. You don't have to be rich. You don't have to be young. You don't have to be old. I mean, anything, right? It's like like Disneyland. There's a ride for everyone, right? And the thing that I shared at the beginning of my presentation, the 3 simple ways to invest, is I would say the easiest way and the most reliable way to take advantage of the market with very limited effort. Okay, so peso cost averaging good quality companies over the long term, right? So that's what I explained. Of course, again, this is not the only game in town. Diba? Baka meron iba sa inyo, if you have experience, you want to say, I know better, right? Because I have experience already. I don't want to do this. I want to trade. I want to use technical analysis, whatever. right? I want to do 50% a year. Okay, I mean, you do you. I mean, there's nothing stopping you. Again, the market can be whatever you want it to be. Diba? If you don't want to go to the casino, you just want to risk it. Gusto mo lang double or nothing. I don't want anything else. I don't want 10%. I want double or nothing. You can also do that in the stock market. Diba? If you want to grind, you want to make 1% every week for 50 weeks, that's 50%. If you want to make 1% every week, that's also good. You try to aim that, you try to reach for that. There's several ways to skin the cat. No? So that's why the cat is there. There's several ways to skin a cat. No? So I want to say also don't judge, because people, the stock market, I often hear people, trying to compare one style over the other, right? And that's okay. Comparison is okay, because each individual would have different needs and different resources. That's okay. But I would just say there's pros and cons to each one. There's challenges to each one, right? And as far as I know, for majority of the people, for majority of you guys listening, I recommend this strategy that I just shared early on today. Again, peso cost averaging good quality companies over the long term as the simplest way to capitalize on the market. And once you're in there, then learn some more, and then you could slowly deviate to whatever it is you want to be. But don't use don't make the complications of the stock market an excuse not to learn about it, not to enter it, because there's an easy way to start at the very least. All right, so that ends my presentation for today. And again, I'd like to encourage questions, because I'm not sure what you guys want to know. If you want to know, outlook, whatever, personal investing habits, whatever you want to ask, feel free to to type it in the chat box. All right.
Yeah, definitely. Thank you, Charles. We have definitely corrected a lot of misconceptions today. Perhaps we spilled a lot of fake news. And hopefully some of us come out more encouraged to allocate to stocks. As a disclosure, no animals were harmed in the making of this presentation. Skinning a cat is a term only. Okay, so we'll now proceed to the Q&A session. Please write your comments or questions to the speaker in the public chat space. I guess while waiting, I think there's going to be a common question later, but while waiting, maybe I'll address a few questions from my side first. So you mentioned equity index investing a while ago as a viable form of, say, starting off in the market. Of course, the first impression is that when you invest in an equity index, it's going to be diversified. It's going to be like you're spread across the market. But is it true? Are there any weightings or biases we should know about before investing in, say, an equity index? Should we correct them? I guess is the other question.
What do you mean? But not really. I mean, investing in equity index funds, it's just like investing in the average company. You could think of it that way. The average company. So let's say the equity index funds, they buy the 30 biggest companies in the Philippines, right? The 30 biggest companies, syempre, yung performance naman nila, they're not gonna be all the same, right? Maybe yung iba up 15%, yung iba up 8%, yung iba down 1%. So the risk is, pag ikaw mag-isa bumili, nagkamali ka ng pili, baka mapili mo yung down 1%.
Right.
So what index funds achieve, one of the byproduct is that they buy all 30. So yung mga up 15% would partly offset yung mga down, di ba? And so it's like saying, okay, if the average, literally the middle number in terms of performance of the 30 stocks is 8%, more or less yan din yung return mo. More or less. It's a little bit more complicated than that, but yeah, you're basically just investing in the average company, average Philippine company, right? siguro, as a caveat lang, it's not guaranteed, even if it's average of the 30 biggest company, it's not guaranteed that every single year you're gonna make money, right? Again, it's not guaranteed, but as I mentioned, it's like this, no? So if I ask you, okay, let's take any company na lang, wag na average para mas mabilis i-imagine, diba? Let's say Jollibee. If I ask you, okay, what do you think, will Jollibee make more money, tomorrow or next week or next month compared to this month? I don't know. Right? I don't know. A lot of things could happen next month. Baka inflation mataas pa, ganyan, whatever, and so on and so forth. Right? But if I ask you, okay, what about earnings of Jollibee 10 years from now versus today? And I think that's a much easier question to answer. Of course, it's still not 100%, but siguro I'm willing to bet na my own money, my own savings, to bet that, in 10 years, most likely Jollibee's earnings would be higher than what it is today. And as we mentioned a while ago, the higher the earnings, generally speaking, the higher the value of that company. So yeah, that's already a good bet. Not a guarantee, but already a good bet that over the long term, you should be okay.
Right. I guess that I asked the question because maybe several months ago, before I guess the downtrend in stocks, there were these headlines specifically about U.S. indices that because of the overperformance of tech stocks, investing in the SP 500 was essentially like overweighting the tech industry or the tech sector. I was wondering if there was something similar, say, in the Philippine situation, wherein there's like
I
a bias
understand.
towards certain sector. Yeah.
Not really. Short answer is not really. Why? Because the Philippines is, I mean, most of our businesses are traditional businesses. I mean, it's just properties and banks and and restaurants and and manufacturers. That's it. We don't have a lot of more modern industries. I mean, there's pros and cons to that, right? But yeah, I mean, it's basically, I would say it's basically highly correlated with the GDP of the country. So hindi siya na parang, let's say, in the S&P, yeah, I do understand that risk, right? Where it's not as representative of the of the whole economy, right? Rather, it's just a subset, right? Because of the the mega caps, they call it the mega caps in the US, the tech names, right? But I don't think that's an issue. Even in the US, to be honest, even if you push it, the thing is with this index funds is that they what do you call this? They rebalance their portfolio regularly. So pagka masyadong malaki and then let's say other companies catch up or the tech companies decline in value, they also adjust their positions accordingly. So over time, even if you're buying the same index fund, your exposure changes over time as well, right? So over the long term, I don't think it matters as much.
Got it. That makes sense. We received a question. Thank you from Johnny Morgolisao. As a reminder, please remember to send the chat to everyone. This was sent to me specifically, but I'll combine two questions in one. He mentions the current rate environment, that it's quite high. Are there certain sectors that would benefit from this current rate environment, or certain perhaps geographies? And he specifically asks about REITs. Is there a particular case for or against REITs, as far as you would know?
With regard to the high interest rate environment, the main beneficiary of this one, at least in the Philippine setting, are really the banks. Because of what we call the spread. Meaning, if you notice, yung mga deposits nyo with the banks, hindi naman tumataas yung interest rate. Mostly the savings deposits, they don't really increase that. Or even if they do, it's just a very small amount, right? On the other hand, the lending rates, they do increase. Your borrowing rate, their lending rate, they do increase that, right? So now they're charging more for loans, but they're paying same or same-ish for the deposits, right? So the spread gets bigger. So the banks have been benefiting for that. Their earnings for this year has been, fantastic, right? The thing I'd like to note though is that, again, I always say markets are forward-looking, right? And so now people are no longer talking about high interest rates; they're talking about declining interest rates. Kasi kumbaga, that's what the consensus view is now, that they think that inflation would start to slow down globally, and that interest rates would follow down, and in that case you should be looking at companies that would benefit from a lower interest rate. Now, moving on to the second question, diba, on the REITs. REITs, you could think of REITs as as a similar to bonds, fixed income, wherein they're inversely correlated with interest rates, meaning as interest rates go up, their value declines. That's what we saw this year for REITs. Malaki binaba nila, almost all REITs in the Philippines, right? But as interest rates normalize, as interest rates go down, then our expectation is that the value of these REITs would also go up. So I'm actually on the bullish side when it comes to REITs, also with the bonds today, because again, I share the consensus view that interest rates would start to normalize already, would start to go down already, and yeah, you could see price appreciation in both bonds and REITs.
Yeah, thank you for that. Those are very interesting insights into probably currently a high yield environment, but definitely next year we might be talking about the opposite case. I guess let's pivot off that and ask you, in terms of like your general forecast as well. We've talked about sectors, but do you have a specific geography that you favor for, say, 2023?
Okay. Yeah. Short answer is Philippines. Yeah. Okay. Let me share this. No, so the Philippine market, 2013, 9 years ago, the index, again, the average peaked at 7,400. That was nine plus years ago, right? Now, 2022, it's at 6,500. So the market didn't go up, right? In fact, the market declined, the Philippine market declined the last 9+ years, right? On the other hand, in terms of earnings, yan yung the two things that we always talk about, the price and the earnings, right? In terms of earnings now are much bigger than what it was 9 years ago. In fact, it's probably close to double already next year's earnings compared to earnings 9 years ago. So in terms of bang for your buck, right? In terms of the valuation of the company, the price of these companies, they're now much more attractive than what they were 9 years ago. Diba? And parang ano rin yan, you could liken it to the Microsoft example. Of course, I'm not saying we're gonna, times 10 over the next 10 years. I'm not saying that. Diba? But at least in terms of the direction, I'm really quite bullish in the Philippine market. And maybe if you want another explanation for that, is that the main risk next year, okay, globally, I think the main risk next year is no longer inflation. Kasi nga, what the Fed did was that in all the global central banks, what they did is that they increased rates very aggressively. Diba? I mean, in modern history, one of the most aggressive rate hikes, right? And so there's a good chance, in my view, that next year wala nang inflation risk. I mean, pababa na yung inflation, but the risk now becomes recession. Yan na yung pag-uusapan. That's the biggest risk for next year, global recession. And if there's one thing that the Philippines, kumbaga, pag papipiliin ka in the Philippine setting, inflation is more of a concern than recession. Diba? Kasi because of our remittances, BPO revenues, these are very, very resilient. And not to mention low base pa rin tayo coming from the pandemic versus in the US market, wherein basically yung pandemic sa kanila months lang. Months lang yung lockdown. Baka wala pa ng months eh, di ba? Para ayaw nila mag-mask. I mean, even early on. Now, in the Philippines, this year lang, fourth quarter lang nagsimula yung face-to-face class. Di ba? So, our reopening play has been delayed compared to the US and the other developed countries. One of the laggards talaga tayo. So, simply from that low base effect, we should see growth in terms of, GDP and revenues and earnings of these companies for the coming years. No? So if US gets into a recession, I don't think the Philippines would be as impacted, and I don't think we'll get into a recession as well. So yeah, that's also another positive thing.
Yeah, you've definitely made a good bull case for the Philippines in that aspect. Which I think the next question is interesting. I guess to further support that case, perhaps. Do you see that bearing out currently in terms of like net foreign flows? I guess there's also a question on comparing like Philippines against the other ASEAN 5, growth, FDI, those economic variables. Do you see it like reflecting there as well?
Maybe I can focus more into the stock market flows, because I'm not sure if you're talking about the foreign flows for the stock market or for the real economy. For the stock market, it's actually the opposite. They've been selling for the last 9 years, which you might say is bad, but if you think about it also, that's good, because when we computed that, basically they sold off everything they bought since the global financial crisis. Kumbaga, everything that they bought since the global, in terms of amount, amount, they've already sold the last 9 years, right? And so we think that malapit na, kumbaga, wala na silang bala, or malapit na sila maubusan ng bala. And then if ever they do decide to come back, when they do decide to come back, you'll know. Right? Because you won't be asking, I mean, it's gonna be obvious. Because by then, I mean, diba? I mean, what I'm trying to say is that what we've experienced the last 9 years is mostly because they've been selling. Right? Kaya flat yung market or slightly down. But again, I think with the compelling valuations, with the improving outlook, right? And also in a way, with the deteriorating outlook in the developed countries, like Europe in the US, they have more incentive now to come back to developing markets like the Philippines. Right? So yeah, so wala pang significant na inflow so far, but yeah, our view is that even if they just stop selling, even if they're just neutral, markets will already go higher.
I suppose that's the local support that some may be talking about.
Yes. I think to the tune, I can't remember that, like to the tune of like $50 billion na ata. Parang ganyan yung nabenta nila over the last 9 years. So it's like a really staggering amount.
Yeah, definitely. Since we're on the topic of indicators like foreign flows, we have a lot of indicators, like if you read the news, like GDP, inflation, which has been the topic recently. Do you have like one or two indicators that you found to be useful in like sensing where the market is?
I do, but okay. At the risk of making it a little too complicated, I don't want to make anything complicated today. But one thing we look at right now, especially right now, would be the 10-year yield, the 10-year bond yield. You could say just US 10-year bond yield, right? And the reason why we pay close attention to that is that it tells you what the market expectation is with regard to the inflation and the Fed's policy, right? If you look at the 10-year yield today, actually, okay, before today, malaki inakyat niya for 2022. It went from a low last year of 1.5% to almost 4.5%. That's super big, from 1.5% yield to 4.5% yield. That's a super big move, right? And now it's correcting a bit to about 3.8, 3.7%. So again, yeah, that's why you're seeing some rallies now in the equities market, not only in the Philippines, but also globally. Because they're saying, the interpretation for that is that they're saying that they think that inflation would now be under control, right? And then the Fed would sooner rather than later start cutting policy rates again. Basically, hindi na sila naniniwala that inflation would accelerate further. Of course, this could change anytime. There's no guarantees in the stock market. We're always dealing with, probabilities and uncertainties, right? But yeah, at least that's our bias for next year. The rates are gonna continue to go down, but that's something that we monitor definitely.
So I guess look out for the 10-year bond yield is one indicator that you may want to look at.
Yeah, or just invest regardless of the 10-year bond.
Or just invest, exactly.
That's the easier way. Again, just do peso cost averaging over the long term, diba? Malaki na yung natipid nyo by starting now. And not starting a few years ago, diba? Kasi marami rin. There's lots of events that happen in the Philippines, diba? That set us back. You might be asking, diba? Bakit 9 years hindi umakyat? What does it say? Diba? Yeah, it's multiple reasons. One reason is also naging overvalued tayo noong 2013 kasi everybody was, ewan ko kung naalala niyo, probably not, but at that time we were the darlings globally in terms of investment markets, right? And so naging mahal tayo. And also, di ba, we had issues recently also with COVID. One of the most affected yung Philippines. Diba? Because of our lockdown, we basically have the strictest lockdown next to China. Diba? We have the strictest lockdown for the last 2 years. And now that one becomes our biggest selling point. Diba? Kasi low base tayo. Lahat sila high base na kasi matagal na sila reopen. Tayo ngayon pa lang magta-travel, diba? Tayo ngayon pa lang magkakaroon ulit ng trabaho and would start to spend again, diba? Would start to eat out again. So that's low base. And also, start of the year, actually, to be honest, I was also bullish in the market before the Ukraine thing happened and before inflation basically shot up to the moon, right? And so these are unfortunate events, but the thing to remember siguro is that businesses are very resilient. Our businesses are very resilient, and in a way, maganda na yung nangyari the last couple of years. Kumbaga, tested na sila. Yung mga mahihina, they've already probably went under, right? The last 2 years because of the pandemic. Ma-pandemic ka pa naman. kung hindi ka nagsara during the pandemic, you're probably not gonna close next year.
True,
right?
true.
So, di ba? So, kumbaga na-filter out na. And even the bigger companies also, like for example, Jollibee, di ba? Usually what the pandemic forces you to do, because wala kang choice on your revenues are down 50%. What choice do you have? You'll be even more lean. You'll become even leaner. Diba? You cut back unnecessary expenses. Diba? You optimize your whatever operations. Diba? You become more efficient. Such that pag bumalik, even if revenues don't go back up to what it was pre-pandemic, they're already making more than what they made pre-pandemic. Even if revenues are still lower. Yeah, that's the actual case for Jollibee. So you see Jollibee share price going up na. Diba? So these things, you could always view them positively or negative. But again, in some ways, I don't want to overcomplicate things. Over the long term, these are the biggest names, diba? and I'm willing to bet on them personally.
Yeah, definitely. Like that, the pandemic has definitely like called out a lot of the weaker businesses, making a stronger case for the Philippines. By the way, a lot of our audience are either CFA candidates or charter holders already. So feel free to be more technical. I think is the message, because I wanted to pivot off your analysis, say, of Jollibee, and ask, say, in your work as as the head of research, or perhaps personally, do you have a preferred valuation method? Because we know like cash flow discounting, you have like ratios, you do technical analysis as well. Any of them? Do you prefer any of them, perhaps?
Um, no. I don't prefer any of them. In fact, I do all of them personally and professionally. Because each one would have their own pros and cons. Diba? Like for example, DCF is the most, the most, you could say the most intrinsic valuation method, meaning that really aims to, to get the true value of any asset, right? But the problem with the DCF is that it's very sensitive to assumptions. And if you don't, if you have like limited experience, then the assumptions won't be intuitive to you to make. And as we know, diba, as with anything else, garbage in, garbage out. So even if the formula is correct, the model is correct, the idea is correct, but the assumptions are off, then the target price could be double what it really should be, or half what it really should be. So there's a huge room for a huge volatility in the final estimate, right?
Final price.
Let's say relative valuation, the upside would be that it's very intuitive, much more intuitive, much easier to understand, right? But the downside is that you're relying on similar assets, no? And sometimes it's very hard to look for similar assets for several reasons, right? It's very hard to look for exactly the same assets, right? Technical analysis also. I'm also a believer in technical analysis, even if I'm an analyst by profession, right? I also acknowledge that they do work. There's a place in there, right? But these are the things that could make investing more complicated, diba? And it might be for you, it might not be for you.
Right. Okay, so all of them have a place, I suppose, in the in the environment.
Exactly.
That's true. I guess let's move a bit to something that's more recent. I guess the rise of social media has been interesting in terms of like stocks. We know the Reddit phenomena in 2020 in the US. In the Philippines, we have our own small examples. We have Facebook groups, Viber groups. Traders Pizza was a thing like maybe a couple of decades ago or something. Do you think they're like a force for good to introduce investors, or are they more of like a danger because they introduce more fear and greed into the market? What do you think of social media in investing?
For me, it's on its own. It's neither good nor bad, diba? As with any platform or any technology naman, diba? Like for example, COL, we also try to use that or to leverage on those social media to expand the reach, diba? So and I think that I'm not exactly sure like as to the which one would be more common, diba? The useful ones or the not so useful ones. But I would say, siguro, safe to say that there are some that are very useful indeed, because one of the challenges in investing, diba, as I mentioned a while ago, there's just a lot of information, diba? And sometimes it's hard to monitor everything by yourself, diba? So if I could give one advice to people, is that to have your own group, diba? Because for me personally, I'm lucky because I'm doing this professionally. So I'm basically around people who think about the markets every day, right? But if you're not, then again, it's harder to stay updated with the developments in the market. So I do advise you to find your own group. No, whether it be your friends, di ba lahat kayo nag-invest or share kayo, or you join, you join these groups. But again, make sure lang that they have your interest in mind, di ba? They're just not trying to, promote their own stock and, pump it and then sell it to you. It does happen, di ba? As I said, di ba? There's a game for everybody. Diba? There are people who do that. I don't want to name names, right? So make sure that they have, the group or the organizers or whatever have your interest in mind, rather than una sila tapos sunod kayo so I could sell after, diba? So that's the risk.
Yeah, definitely useful advice in terms of like how to use social media responsibly. You mentioned like the sense of community is important in encouraging each other. I guess maybe I'll leave that as the last question. I don't see any questions further in the chat. As a last question, jumping off that advice, would you recommend, say, maybe any books, any videos, any particular websites that we could follow if we wanted to learn more about stock trading or stock investing?
Ang dami. But okay, sige. Since I'm a fundamental analyst by profession, I recommend following As Was the Modern. You could just Google his, the guru of valuations, di ba? Of stock market valuations. So you could just Google his website. He's very generous when it comes to his lessons. I think lahat yung lessons niya sa NYU ba yun? He shares it online eh. So you could just watch that for free. He posts regularly about the market, about valuations, about anything stock market related, about his views. And even me personally, I learn a lot. No? I really try to read and watch his videos regularly.
Yeah, I think what his book was The Little Book on Valuation. If I'm not mistaken.
Yes, that's also true. But I mean, kasi for me, like at least personally, I prefer listening or watching videos rather than reading books. It's own preference naman. But I think you could do either, di ba? May book siya, may blogs siya, basically he writes. He also videos himself. Kung ano yung sinulat niya, there's a video format of that, of himself explaining it, right? So so very useful. So I recommend it to anybody.
Yeah, and I guess the best advice really is to try, because it has never been easier to get into the stock market, whether it's indices or individual securities.
Yeah, and maybe as a last point nga, no, kasi what I don't want to happen, I think my objective for today is that there's really a lot of things that you can learn here. But I don't want that to be the barrier na parang, sige, since hindi pa ako marunong, hindi muna ako mag-invest. Or baka next year na lang aaral muna ako, di ba? Because that delay is sometimes not very realistic. No? Next year becomes next. 5 years becomes 10 years. No? But what I'm saying is that there's a super easy way that you don't even have to do any of these, right? Just buy them. Just, ulitin ko na naman, di ba? Yeah, but what I've mentioned a while ago, di ba? There's a way to, for anybody. In fact, as an anecdote, no, my son is turning 7 years old soon, and I'm starting to teach him how to invest already. So I think I'm planning to start him within the month, right? Start investing, start buying within the month. So if my 7-year-old son can do it, then I'm sure everybody in this room can do it, right?
Right. True. It's also never too late to begin for those who have never tried it before.
Exactly.
As you mentioned, peso cost average. If you look at equity indices first, if you're overwhelmed by the number of stocks in the market, invest in good companies, as you mentioned. Those are all like good advice that we can definitely take away. I guess that's pretty much it for the questions, unless one or two come back. But having said that, thank you again, Charles. To our participants, please turn your attention to the screen for the QR code of our online evaluation. Please take time to answer the survey. It will take you 1 to 2 minutes to complete. So let's give it maybe a few seconds so everyone can capture the QR code.
Thank you also for having me.
Yeah, definitely. But before you go, of course, for everyone who has video capability, let's turn on our videos for the photo opportunity with our guest speaker for today. So there. Let's see everyone's faces, hopefully. Precious, would you be taking care of the picture taking?
Yes po.
Sige. Turn your videos on, everyone. Sige, just do the countdown, Precious, for the picture taking.
Okay, 1, 2, 3. One more. 1, 2, 3. Thank you.
Yeah, thank you. Thank you, Charles, again for this session. And thank you, everyone, for joining our info session. Again, CFA Society Philippines would like to thank our sponsors. Our platinum sponsor is Sea Oil Philippines Incorporated. Our silver sponsors are BDO Capital, Coco Life Asset Management Company Incorporated, and FTI Consulting Philippines Incorporated. And our bronze sponsors, AP Securities Incorporated, DBP Daiwa Capital Markets Philippines Incorporated, and Papa Securities Corporation. Event partners have been FMAP, MART, and Sharefill. So this concludes our webinar. Accept our sincerest appreciation for your time and effort in participating in today's webinar. Thank you, everyone. Thanks, Charles. See you in our next event. All right. Thanks, everyone.